All right, so continuing on this study, I went over the factors about price, volume, and time. Just price, volume, and the combination of both of them. But now, going into this the study. Okay, the next study is Anaconda. This is okay. The hell was I? All right, so Anaconda is on a trading range between 14 and whatever, which it broke on increasing volume. So where does he give the page number? Okay, page 32. So it broke on increasing volume, probably right there at A. And there's no sign of rallying power, so it continues to go down. When we see evidence of a selling climax in the abnormally large volume accompanied by a sudden sharp acceleration of the downward movement. Alright, so this broke on heavy volume here, and then whatever, you know. So where's this A, B, and D? So here you got your breakout. Here you have your selling climax. So what he's saying is that it continues with no sign of rallying power. We see evidence of a sudden climax in the abnormally large volume accompanied by a sudden sharp acceleration of downward progress to $10 a share. We conclude from this that demand is now overcoming supply, and with the stock in an oversold condition by virtue of the precipitous drop. Alright, so it's oversold. Why is it oversold? It goes straight down without rallying. How he comes from demand overcoming supply is from the high volume. Why? Because someone's taking the other side, and that's a lot of volume. So demand. He believes that demand is overcoming supply, but again, it's not a good idea to just assume that. You need a lot of other things. What you can say is it's in a, it's not a place to short. That's what you can say. We must anticipate a technical rally. So from that selling climax, so you just anticipate a technical rally. Again, not something to trade. By the way, technical rally is the same thing as automatic rally. Alright. Between 14 and 17, there was a lot of congestion. And that it climaxed into a support level. So let's just draw that out. That's the other thing. Like once it climaxes, require, you know, excuse me. You need preparation. Just don't buy a climax. I mean, this idea of just buying the automatic rally, be aware that it could happen, but you're not going for small moves. It's not the point. You're not going for any bounce unless you're applying the day trading method where you are trying to get every bounce. But anyway, so in this method, you want to see preparation in this part of the course. Alright, and giving consideration to the probable number of buyers who are locked between 14 and 17. Why? Because, like, this is the first time he's going beyond the chart, you see, and he's saying that buyers are locked. Why? There was a congestion area. Heavy congestion area or supply level 14 to 17. So just say that into 17 buyers trapped. He's identifying where the buyers are trapped. See, like he's going beyond the chart. He said that between 14 to 17, it's over here as well, like buyers are trapped. Trapped. So anyway, they're screwed. So we must assume that the sponsors of the stocks are not likely to run it up immediately up to this former distribution level, merely to bail out all these frightened bulls. Rather, if they plan a bull campaign, they will wear down the overhanging resistance by allowing the stock to remain sluggish and depressed. Alright? So the CM technique here is to manipulate time, not price, but time, to wear out a trapped buyers at 14 to 17 trapped and 14 to 17 trading range. Okay, the other thing to note is like a lot of folks, they just don't get it. Like when Bitcoin broke last Thanksgiving, right after around last Thanksgiving, around when the CME futures came out, it broke. All you hear for on YouTube and all this and that is that, oh, Bitcoin's going to come back, Bitcoin's going to come back. Do you know how many folks were trapped in when it went to around over 18,000 or around that area when the CME futures came out? They're all trapped. There were record number of applications to, I think, one of the brokers, or many brokers. There were record number of applications that went there. Record number at that time. So all those buyers are trapped in Bitcoin, and it's been 1 year. only. So from that time till now, all you see is like Bitcoin eventually going to come back and this is going to come back. It's not going to come back that quick. There are too many buyers that are trapped there. And that's why it's going to take a long period of time in order for these crypto, in my opinion, the crypto market to come back. Because once they're stuck, you cannot take price and just go back to that level, because that becomes a very big supply level. So this is the same case over here. Imagine this is Bitcoin and these all these guys stuck at 18 to 20,000, whatever it was. The idea that it's just going to come back to this area and then break right through is not going to happen that quick. It's going to take a long period of time manipulation to tire out those traders. Okay, so as long as interest is still there, that they have to be shaken out, but not through price. I mean, I think right now Bitcoin broke pretty bad, so maybe there will be, but it's going to take time. And definitely knew it was not going to happen within like a small period of time, given the advance. Anyway, where am I? With this background to guide us as of, where am I stuck? There was a port around 10. Okay, so we can hardly expect an enduring advance to develop out of a selling climax without substantial preparation. That is giving consideration. Also, like the SPY move that just happened recently, it broke. I was explaining this in the prior call that there's no preparation, there's no cause. So whatever you're seeing is some type of rally. It's like a covering rally or whatever. But just take a look at yesterday's date, whatever this is, and you see the break, because the rally that was initiated had nothing. There's no preparation. That's the key point. For significant advance, Bitcoin or SPY, whatever, you need preparation. You need a bull preparation, meaning heavy accumulation. It's not there. Anyway, that is giving consideration to the probable number of buyers who were locked in between 14 to 17. We must assume that the buyers of this stock are not likely to run it immediately up into the former distribution level merely to bail out all the frightened bulls. Rather, if they plan to begin a bull campaign, they will wear down resistance by allowing the stock to remain sluggish and depressed, tiring out the public, endeavoring to shake them out. Or perhaps they may lay the foundation for a later advance by using both devices. What devices? Time manipulation, price manipulation. Those are the two devices. An experienced operator knows that he can most easily force the public out of his stock by having it weak for a long period of time. Could be 2 years for Bitcoin. I don't know what it is, but we'll see. Most market followers, at least the less informed variety, are notoriously impatient. Very important. They crave action, seeming to think the stock ought to go up immediately merely because they have bought it, especially when a bull market is developing or well underway. There are many such people constantly jumping into anything that gets active. The tiring out process is very effective in discouraging emotional buyers and sellers and fails to keep on moving. If it rests a while or sags, they may become disgusted and hop into another stock that will move and get hooked on the top. Bottom line is, if they're wrong, right, the way time and price manipulation works is, let's say you bought Bitcoin at 18,000. The expectation was at that time that it would go to 50,000, and some were calling 100,000. So people got in around 18 or 20, I don't remember exactly, but it was pretty high up there. With the thing that with the expectation that they're going to triple their money, about triple their money or more. And when price reversed and continued to go down, that that expectation eventually breaks. When it breaks, what happens is people, they may take a huge loss, especially given current action in Bitcoin, or they will be tired out, or they'll jump into they'll just exit one market and jump into another that is about to move, that they believe will move. This is like, and the reasoning for this is, why keep your money stuck? Why stay in this when that is moving? You should put your money in the market that's moving, or something like that. Well, so that thought comes to mind, and these guys are jump from one stock to the next. Especially in day trading, this is really, really dangerous, because they go into one market, it's not moving, take a loss, jump into the other market that was moving, get in at the wrong time, take a loss, then another market is moving, jump into that one, and then possibly take a loss, and then another market is moving, jump into that. So that kind of behavior you see a lot in stock day traders, that will jump from market to market because the current market, when they got in, they were either wrong in terms of direction, or it's not moving while another market is moving, enticing them to jump from the current market into the market that's moving. Very often the stock will have just sold, will start up. Alright, so it moves after you get out. Uh, Meanwhile, managers, or the second issue, which is now strong, pedal out a little on the bulge to those chasers after things that look good. Therefore, with these principles in mind and seeing the selling climax in Anaconda, we conclude that the stock is not yet a logical purchase for a large advance, where a proper foundation has not been laid to overcome the old ceiling. Bottom line is, you want a big base. So so the other stocks are better off. Why? They don't have a big ceiling, supply ceiling. All right. This also can be applied to crypto. Like if I was looking at crypto and saw Bitcoin, everyone's stuck in it. What are they not stuck in? That would probably, like a newer coin, probably be looking at that. That's why you must know the past history of a stock. Very important. Like for gold, I think it was 20,000 or something. There were a lot of folks that got into gold a few years ago, maybe 2 years, 3 years. he talks about stops. Like, I'll go into that later. Mm. So you see there's a rally here somewhere. After the climax, sluggish rally. So here is your automatic rally. I don't know why I'm calling it automatic. Technical rally, sluggish. Okay, so he's expecting the technical expect sluggish. Expect another reaction. What he's talking about ABC? What the hell is the ABC? Let's see, ABC. Is it here? Is it here? Is it here? I have no clue what he's talking about. ABC is fucking. Anyway. Down trend line. Okay. So on the 30th, can't see shit. That's 20 somewhere around. Alright, so there's a low volume. There's your low volume test, which says the market there's no, everyone knows what low volume test is. after that, you have a low volume rally. So you're having a low volume rally after low volume secondary test. Low volume secondary test was a bullish indication. Low volume rally is a bearish indication. When it's sluggish on small spread, that's when it is. Alright, so what does that low volume rally mean? Prices. August 4th, you get a screw bar. You see? Bang, right there. We have to be very alert, ready to run quickly with respect to stock we are holding for the short swing trade. On the other hand, if you bought the stock primarily to try for a large advance, then in the event we would be content to sit tightly depending upon our stop. Blah, blah, blah. But on the short swing, we must cut our losses because we are trying only for small profits. So you see a big bar, we're looking for the reaction. So the only bearish indication he has is the suddenness of sudden hypodermic. Rally looks bullish. But the bearish indication is the hypodermic sudden volume. So basically it pulls back on low volume. The volume P. On the 13th. Where is the 13th? There's your SOT. OT. And all of this was like a halfway back move. lost it. Rally. Alright, so it's rally to resistance and finally it goes into a hinge position. Alright. that low volume on the down move is not bullish. It's bullish only on a pullback. The low volume rally down over there means that nobody's willing to hold the stock up. Okay, I'm gonna stop now because I've done a lot of shit. Anyway, so let's just sum up everything. Over here, you had buyers that were trapped, then you had a selling climax, and you had an automatic rally that was sluggish. You had a test again on low volume, the low volume test of the climax that said it was bullish and finally rallied, but it rallied with too much strength and showed the appearance of a hypodermic maneuver. It pulled back and rallied a little bit higher, indicating a shortening of the thrust, and an immediate reversal that went down. When it went down, it went down on low volume pullback. That low volume pullback was saying expect another rally to at least test the highs. That's what happened. When it did test the highs, it exhausted, and then it started moving sideways. Volume started diminishing and formed a hinge. From the hinge, it broke. When it broke, there was low volume on the down move, and that's not bullish. That's actually it's the same as bearish, but it's the low volume means no one's willing to step in and take and really support the market. All right, so this low volume rally is not bullish, it's bearish, and distinguish that differently than low volume pullbacks. On its way down, it rallied and made an up thrust, and that up thrust is one bar up and one bar down right over there. Just right up thrust. His idea of an upthrust here is just upthrust. The way Wyckoff used it was just like the high to high, meaning the up waves, or the down thrust was low to low, down waves. So when he talks about upthrust, it's different than the newer course, or what most people say. Upthrust is a signal in the newer term, like springs and upthrust, but in Wyckoff original, he's talking about high to high, and then the shortening of the up thrusts versus the shortening of the down thrusts are indications, behavioral indications, not triggers. Anyway, so it goes down on low volume, and that is still bearish. The up thrust is bearish, and I think we're over here now, and that's where the market found some support. It was the same area where it found support previously. Okay. The key thing to also notice is that the market basically rallied. There was not sufficient preparation for a big rise. There was enough to have a normal, slightly above halfway back or around halfway back reaction to test ice or to test the breakdown, which is what occurred. As it was testing the breakdown, there was a hypodermic maneuver and a retest and exhaustion and a hinge and a break. Alright, so that basically sums up everything. The other thing to note is that in that box there was trapped buyers, so the chances of the market going back to that box is slim. It might go under the box, it might test the lower edge of the box, but to go really into that box is slim because the smart money will have to take the other side of the trapped buyers, and they don't want to do that. Right? So they want to go up there as, but not really give the ability for trap buyers to get out, but just kind of like go up there enough. And then after that, I'll cover the rest of this in a future session. Again, I know these sessions are very long and boring, but the idea is to like is for you to do something similar, not to just watch the video, because you're not going to learn just by watching. You're going to learn by applying and use a similar technique like what I'm doing here, bar by bar, or paragraph by paragraph, and making it graphical, so it's more, you basically have to work through the course. All right, anyway, take care, bye, and happy Thanksgiving.